All right, let's kickstart the first conversation of the day, and that is understanding fixed income investments in a little more detail. We'll talk about fixed maturity plans, we'll speak about target maturity plans, the difference between the two, and how they stack up against fixed deposits, which all of you are quite familiar with, I'm sure. PV Subramaniam is the Chief Executive Officer of Subramani.com, and he's joining me on the program. Good evening to you, PV. Thanks so much for taking the time. Let's start with a brief understanding of what each of these is. We'll start with fixed maturity plans and then we'll go to target maturity plans. But what are fixed maturity plans? What purpose do they serve?
Well, let's start with fixed deposits because this is a very old product which all of us seem to know, and then our grandmothers and grandfathers may have dealt with this. So, fixed deposit is something which you keep in a bank or in a company for 2 years or 3 years, could even be for a shorter period of 45 days, where on the maturity they tell you that they will give you your 100 rupees back with 7% interest or 8% interest. That's a fixed deposit. Now, people are very comfortable with a fixed deposit because you know two things. You know you put 100 rupees, you will get back 100 rupees, you will get 7% interest, and you will get it on the due date, 45 days or 365 days or whatever, 3 years, whatever. You will get it on the same day. There is nothing left to chance. The only thing you're asking is it a good bank? Will I get back my money? Now, the mutual fund industry had to mimic the fixed deposit, so they came out with two things. One is a fixed maturity plan, and one is the target maturity plan. So, fixed maturity plan again does the same thing. It buys some bonds, etc., creates a plan and says 3 years from now you will get back this money at approximately this rate of interest, which is more an indicative rate, but very likely that you will get back. So, it is the rate which they receive minus their expenses, and that is what you will get. A target maturity plan, on the other hand, sometimes has a longer tenure than, say, a fixed maturity plan. A fixed maturity plan will normally have between 1 to 3 years. A target maturity plan could be longer, could be 3 years, 5 years, 7 years, could be anything like that. That is what distinguishes the three years.
The other distinguishing factor, of course, is the ability to pull out of a target maturity plan, right?
Well, technically, both are liquid. A fixed maturity plan gives you liquidity by listing. So, technically speaking, it is listed. So, whenever you want, you can sell. Target maturity plans, on the other hand, are open-ended. So, anytime you can go to the fund house and give it back. Target maturity plans could even be could even be an ETF, which means it's listed and you can sell it every day. Now, when I say an FMP is listed or a target maturity plan is an ETF, you shouldn't assume that they're very liquid. So, to that extent, they may not be very liquid, but yes, technically, you have liquidity which is better than the fixed deposits of banks. But remember, even in a bank, you can go and break it premature. So, in a target maturity plan, that's what you're doing. You're trying to take the money premature, and you may not get the price that you want for it. But yes, technically speaking, all the three instruments that we spoke about are all liquid.
If we were to talk about comparing the three for the purposes of how they would be used in an individual's portfolio to achieve certain goals, what purpose would they serve, one, and two, how would you compare between these three?
So for somebody like you, Alex, I wouldn't go near any of the three products. All three are extremely tax inefficient, so I would not go near them at all. But if suppose there is a person who's got a kid who is now in class 9 and he thinks he needs money when the kid completes class 12. Remember, this is a very fixed goal. It has to happen on the due date because the child will pass class 12 and then he or she needs the money. So you would go and put money in an FMP which will mature exactly on the date when you want the money, right? Or say a week or two before that. That is why you will put money in a FMP and hope to stay on till maturity. Or you could do this even with a bank fixed deposit. Unfortunately or fortunately, if you keep it in the bank fixed deposit, you pay tax on the interest on a yearly basis, and that could be at your maximum marginal rate. Whereas if you kept money in an FMP, because you're holding it for 3 years, and let's say 3 years and 5 days or 3 years and 10 days, you will pay much lesser tax. You will be more tax efficient than a fixed deposit. Same thing for a target maturity plan. And it is assumed that you will require the money only on that day, because if you do a premature encashment of any of the instruments, it gets a little inefficient in the sense that you will get lesser interest and you will perhaps pay more tax.
Okay. Could you explain the tax treatment of target maturity plans and fixed maturity plans?
Yeah, see, what happens is if you hold a equity fund for 1 year, then it is tax free. After, I mean, you pay long term capital gains at a lesser rate. Now, if you hold a debt fund for 3 years, so if you invest in a FMP or even in a target maturity plan, which is maturing after 3 years and 10 days, then you will pay lesser tax than you would pay if you held it for 3 years. So it is more tax efficient than a bank fixed deposit. Having said that, please understand in an FMP there are a series of documents, a series of paper. So if one paper were to fail, then you may get lesser amount, and at least I think Kotak Mutual Fund did it. They would just force you to roll over. So that is a risk that you run in an FMP. The quality of paper in a target maturity plan is slightly higher. They don't deal too much with credit risk. So, so your target maturity plan is better if you know that it is maturing in 3 years and 10 days, or 3 years and 12 days. You're better off in a target maturity plan than in an FMP. FMP, you run slight risk of the quality of paper, that is credit risk. In both of these, you don't run a interest rate risk, but yes, you run more credit risk in an FMP than in a target maturity plan.
Focus a little bit on that interest rate risk aspect of it, um, because even before March this year, or the first time that the Reserve Bank of India increased interest rates, of course we were seeing bond yields go up in anticipation of that increase in interest rates. But over the last couple of years, PV, a lot of advisors were saying that if you are going towards debt mutual funds, then perhaps it is a good idea to stay on the shorter end of the spectrum. That is, in ultra short, in more liquid funds, that overnight funds, because of the lower interest rate risk. How do you explain this in the current context, with the interest rates having gone up, the policy rates having gone up by 140 basis points?
I would, if I were a retail investor, I would rather go and put money in floating rate bonds, because I know as and when the interest rate get reset, I'll get a higher rate. If I am in ultra short bond fund, I have to guess the date on which I have to shift to a longer maturity fund, like a gilt fund or something like that. I don't know how many of us will be able to do that. So I would rather go and put money in a dynamic bond fund or a floating rate fund, where I let the fund manager take a decision to keep some money in the shorter duration and some money in the longer duration, typically what they do, or be in a floating rate fund and say, okay, I'll be in a floating rate fund, and as and when I think interest rates have peaked out, and then I will shift. It is very difficult for a retail investor to do that. So I would rather say, if you are not very particular that you want this money on a particular date, like we were speaking of FMP and target maturity plan, we know the date on which we will get the money. If you are not very particular about that, I think floating rate will work well, and any even a gilt fund with 3 years to go for maturity, anything like that will also work. But I would stick to floating rate or a dynamic bond fund.
That's a fair point. But if we were to discuss the potential of the target maturity plan in locking in money in a fixed income instrument, assuming that we've and of course what you're saying is absolutely right, PV, in that nobody can guess where interest rates will go and how long they'll stay where they are. There are some expectations that there will be another 25 basis point hike in the policy rates. So therefore, there's an expectation also that the long end of the spectrum on the bond side, bond yields, will go a little higher from where they are right now. But theoretically, if you were to speak about it, would you say that it makes sense to, if you need to structure this in a particular goal, like you said, if you need something in 5 years' time and you're doing a mix of equity and debt, for the debt component, would you say that it makes sense to look at a target maturity fund?
Yes, if you have a target maturity plan which is maturing in 5 years, yes. If you don't have, then what do you do? And also, see that at various stages you want to lock in some money. So if you have 100 rupees, maybe you lock in 30 rupees. You wait for some more time, interest rates go up, you lock in another 30 rupees, and you wait with just 40 rupees. You don't wait with the whole of 100 rupees saying when interest rates go up, I will lock in. What happens if interest rates don't go up? What happens if the US sees a recession and says, okay, now we are not increasing interest rates. India cannot increase interest rates if the US is not increasing interest rates. So we don't know. We're leaving all that to chance. What happens if the Ukraine war stops and suddenly there's a lot of cash inflow coming into the country? What happens if India gets in the international index of debt funds? Then suddenly money comes in, so interest rates might go down. So partially you lock in and partially you wait. Don't lock in everything and don't leave everything.
That's a fair point. That's a very fair point. So then, would you like to spell out a little bit more about how these dynamic bond funds work? Because what I'm getting is, Subhra, PV, it is more, it makes more sense for the retail investor to look at their fixed income investments if they are looking at debt funds, to go to something like a dynamic bond fund, because then they can depend on an expert to decide where to deploy their funds.
Exactly what I was saying. See, don't lock in all your money into just one fund, right? So you put some money in an ultra short, some money in floating rate, and some money in a gilt fund with small maturity, maybe 5, 6 years maturity. So you eliminate credit risk in the gilt, right? But you can also otherwise give it to dynamic bond fund and tell the fund manager, you take a call, how much to keep in the shorter end, how much to keep in the longer end, how much you want to lock in. Let the fund manager take that decision and you don't take the decision. So it's like a go anywhere fund. That fund manager can decide. So that's a good way of giving the money to a fund manager to do that. Having said that, many dynamic bond funds have not done very well. So if you think you can handle it yourself, I would think a combination of ultra short, floating rate, and short-term income fund. You can do a combination of one third, one third, one third, and when interest rates go up further, you can shift some money into gold. I don't think the interest rate is going to touch 8%. So if you're at 7.5 or 7.6, just bite the bullet and take it. It may not touch 8. You have very little left on the upper end.
Finally, what advice would you give to the large number of people out there that are just very comfortable with fixed deposits and deploy quite a lot of their money, their fixed income investments, they deploy in fixed deposits? What advice would you give them to sort of maximize what they get, or should they not worry about that at all? Should they focus primarily on convenience and on safety of credit or safety of funds?
Safety of funds would mean you go to something like a State Bank of India or an NBFC bank and keep a deposit there. So it's not very efficient. You get low rates of interest and the whole thing is taxable on a yearly basis, whether you need the cash flow or no. This makes sense for somebody who is living off the interest. And if you are not living off the interest, it makes no sense at all to go into a fixed deposit. You're much better off going into an ultra short bond fund or a floating rate fund and withdrawing that and when you need. I know somebody who's not withdrawn at all for the last 10, 12 years from an ultra short bond fund. That's great. Just stick around there and don't withdraw. You pay tax only when you withdraw. Unlike that, in the fixed deposit, you pay tax on that on a year-to-year basis, whether you are using the cash or not using the cash. So it is very tax inefficient. But yes, it gives you peace of mind. It means you can sleep well. You know that 7 a.m. if you want the money, you can't get it. But 9 o'clock, 9:30 when the bank opens, you can get your money as quickly as you want. So those are some of the advantages. But if you are happy to take a little bit of credit risk and a little bit of interest rate risk, you have dynamic bond fund and all that available, which might give you maybe same rate as the bank, but it is a little more tax efficient, especially for many of us to keep the money there and don't touch it at all because we don't really need it. We keep it for an emergency and 5 years, 10 years, there's no emergency, you don't withdraw it. So those products make a little more sense.
I think we've covered quite a few bases. Thank you so much, PV, for taking the time. Pleasure speaking with you.
Thank you.
All right, that brings us to the end of this conversation, but there's another one lined up after this very short break, so do stay tuned.